Contextual trading is a principle that dictates the trader must act when two or more trading techniques converge to the same point in the price chart. That's very important because any trading technique generates good and bad signals. When you have two or more different techniques pointing to the same area in the chart, you have a much better chance of producing a good trade. Another way of looking at this is that when two different trading techniques converge to the same point in the price chart, you are trading only the intersection between these two trading techniques. That's the best way of filtering out bad trading signals. Another attribute of contextual trading is the formation of a story for each trade. In other words, every trade must happen grounded on a few logically consistent reasons. Not just a simple setup. That's the best way to counteract the robotic and blind way of merely trading by following simple trading setups. Setups are important without a shadow of doubt, but they are incomplete if a trader doesn't take their context into consideration. The essential point is that every trade you make must tell a logical story to be justified. You cannot simply open trades because an indicator crossed over or because price has reached a support-resistance level. If it was that simple, everyone could become a professional trader in a short period of time. Let's increase the level of abstraction of our analysis and observe the contextual trading principle in its conceptual form. This picture is a good example of how contextual trading works in a metaphorical sense. When traders look at different trading signals from different techniques or theories, they are looking at true sides of the market, not at the truth of the market itself. By looking at the picture, we can see how analyzing one true side of the market can be misleading and ambiguous. If you had to guess what the tridimensional object was by just looking at one of its shadows, you could easily be misled. However, if you combine both shadows, you can arrive at a much more precise conclusion by deduction and elimination of contradictory possibilities. For example, if you were trying to guess what the tridimensional object in the room corner was just by looking at its orange shadow, your intuition would lead you to believe it was a cube. If you were to think a little deeper, you could arrive at the conclusion that it could be a cube or a cylinder, but the second option wouldn't be obvious at all. The same happens with the blue shadow, of course. However, if you combined both shadows, you would eliminate the possibility that the tridimensional object was a cube according to the orange shadow or a sphere according to the blue shadow. It's something in between. One of the tridimensional objects that fit both shadows simultaneously is a cylinder like the picture shows. The conclusion could be much more easily obtained by looking at both shadows contextually. Think of the market as a tridimensional object and the analysis techniques as the shadows. That's why we need multiple techniques working together to access the truth of the market, otherwise we're just blindly trading the shadows. By using this idea of converging techniques in context, the trader has a much greater chance of understanding what is actually going on in any given market. The reason we need contextual trading as a foundational principle is because of something called dimensional loss, which is what happens when we try to analyze a complex entity like the markets through the lens of a bidimensional price chart. The financial market is a multivariate and multidimensional complex system, and the trader only have bidimensional price charts to analyze it and extract useful information out of it. The price chart has one spatial dimension in the y-axis and one temporal dimension in the x-axis. The multidimensional market needs to be compressed and expressed in these two dimensions necessarily. That's called dimensional loss. This idea of dimensional loss is also correlated with something called Bonini's paradox, which serves the purpose to explain why single techniques don't work well by themselves. The Bonini's paradox claims that any attempt to explain a complex system like the markets become less understandable as it becomes more complete. In other words, since the market is a multivariate and multidimensional entity, any attempt to explain it fully becomes less understandable as it becomes more complete. The Bonini's paradox acts as a curse and a blessing in alignment with the dimensional loss of bidimensional price charts. At the same time that losing dimensions in the representation of price is counterproductive, it is the only viable and pragmatic option. The Bonini's paradox also points to the arrogance of thinking that one single indicator or technique is capable of fully explaining the market. In other words, by using setups or single techniques, a trader is assuming these tools have a much greater power than they actually have. However, this presumption is not at all obvious. We cannot fully explain the markets, but we can arrive at useful conclusions using the contextual trading and other principles as well. Part of this challenge is being able to recognize the human intention behind the price bars. This recognition of human intention can only be done by subjectively understanding the market, since it is formed by thousands of individuals with varying degrees of intention and power. To sum up, contextual trading is the gateway to the greater and deeper level of analysis that makes consistently profitable trading possible. In the next lecture, we are going to analyze the principle of multi-timeframe analysis.